short-term versus long-term investing. This is really the crux of everyone's decisions when it comes to the market, when it comes to investing or anything along those lines. Is should you be a short-term minded person or a long-term minded person? And in my opinion, you should be a long term investor. I think short term investors, unless they get really lucky, most of them end up on Wall Street Bets Reddit page, and they're usually talking about how they've lost all of their money on risky financial decisions. This graph here with these reaction images really sums up what a short-term investor looks like. It's almost like a crack cocaine mentality where the line goes up and they're like, oh my God, I'm going to make money, I'm going to make money. And then it crashes and they go, I've lost all my money. And then it kind of bounces back a little bit and they rinse and repeat the cycle over and over again. And this is really a problem that day traders and people who do short-term investing like that tend to suffer from, is they go through these wild mood swings, especially if they don't really have much self-control, which let's be honest, a lot of short-term day traders, some of them will be fairly responsible, but a lot of them will be these 20-year-old kids trying to get rich quick, and they think oh, the next GameStop is just around the corner and they're going to make millions of pounds if they put in some kind of investment money into these risky bets. And ultimately, it just ends up losing out in the end. This is why I think apps like Robinhood are really bad. You should never, ever get into an app like Robinhood. If you want to do investing, first of all, you should see my Should You Invest video and take the advice from that you need to have at least around about £30,000 to begin your investment journey. If you have that much money and you are able to put a good chunk of that money away, then what you want to do is open a brokerage account, a proper brokerage account, not something stupid like Robinhood. Robinhood is designed for poor people. It was made for poor people who want to, have a quick shot at escaping the McDonald's wage cage and, trying their luck gambling on the market, really. What you want to do if you want to be a proper investor is you get a proper brokerage, like Hargreaves Lansdown, I think, is one. I'm with Barclays personally. I do Barclays Smart Investor. In the UK, that seems to be a pretty good one. I'm obviously only starting out at the moment, so I don't know if that brokerage is going to be good long term, but I've heard decent reviews from them. But generally, all of those kinds of brokerages that I just mentioned, most of those are for long-term minded people, people who've got a lot of change that they can slam down on the table and basically lock away in these investment accounts and not have to think about them for 10 years. And so why is long-term better than short-term in that respect? Well, the simple answer is, look at this graph here. Let's assume that this graph is a short-term graph. If you're short-term investing, then you're just going to be up and down all the time, like some kind of schizophrenic person, and it's going to be a nightmare. Whereas the general rule in the economy long-term is that things usually always go up long-term. I mean, if you have a look at the S&P 500 or the FTSE 100 or any of these kinds of things, and you expand the view to 50 or 100 years, you'll see that the chart rockets up. Now, and there's lots of ups and downs, there's lots of fluctuations along that. But if you zoom out to a much more macro scale and you're willing to invest with a mentality of, I'm not going to touch this money for 20 years, well, in 20 years' time, no matter how many down markets you may have, no matter how many 2008 financial crashes you may have in those 20 years, overall, unless Western society completely collapses, you're going to see that graph rocket upwards and you're going to be making a lot more returns than you would have done otherwise. Now, if we get onto that point of, well, is Western society going to collapse? Is it even worth thinking long term? To be honest, that's kind of a silly mentality to have in this respect, because if the market goes down and it stays down forever, everyone is in the shit. All the normies who don't invest, who don't have brokerage accounts, they're all going to be in the shit, because all the businesses that they rely on are going to be in the shit because the market's down and all these businesses are going to close. So really, it's not going to happen, and if it does ever happen, it's going to be so devastating that the least of your concerns is going to be your brokerage account. You're most likely going to be concerned about protecting your house from vandals and thieves in the street who are trying to nick all your stuff, and people who are trying to steal all your food because there's no food left in the supermarkets. That's the kind of world you'd be looking at if the market just crashed and never came back up. And so, with that in mind, you really should have a long-term investment mentality, because if you have a long-term investment mentality, it's almost guaranteed that you are going to be making fat returns. Now, you could say, well, rather than fannying around with all this investment crap, why don't I just keep throwing in £20,000 a year into an ISA account? For people abroad who don't understand, ISAs in the UK are savings accounts that you can put up to £20,000 a year in, and it's tax free. If you're a British person and you didn't know that, you probably should know that you can use ISA accounts and put in up to £20,000 a year and you won't get taxed on it. So why would it be a bad idea to just keep chucking in money into an ISA account beyond like £30,000? The answer to that is really the interest rates that these accounts pay back. If you look at a bog standard cash ISA from Barclays, HSBC, Halifax, any high street bank, they're all going to be under 1% interest rates. They're all going to be hovering around 0.5, 1%. Maybe if you're really lucky, you might get a 1.2, 1.4% account, but those percentages are absolutely pathetic. The typical market average that you get for returns on things like bonds and what you can expect average returns from a healthy portfolio is around about 5%, 4 to 5%. My 1 year fixed term bond with Barclays is at 4.45% fixed, so I know I'm going to get 4.45% of my 15,000 that I deposited into that back. That's guaranteed because that's how bonds work. With healthy portfolios where you've got a mixture of bonds, stocks, shares, everything in the kitchen sink, then with those you can typically expect around a 5% return, so long as you've been smart with what you've invested in. And this is why I would also recommend ready-made portfolios. There's no shame in admitting that you're no better than everyone else in the market. A big problem that a lot of people have is they think that they're better than everyone else. They go out there with the mentality that, oh, I'm going to do it all by myself. I don't need these ready-made portfolios. I can do it all by myself and I'll be fine. Chances are you're not going to beat the Wall Street bros out there. You're not going to beat the professional finance guys out there. Those guys snort crack cocaine for a living, and all they think about from 6 a.m. to 6 p.m. is money, 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 markets, markets, markets. That's all they're thinking about all day long. And so your best strategy is to work with those guys rather than working against them. Because if you do your own portfolios, you're going to start working against these guys and you're going to start thinking that, oh, how can I beat these guys? Just pay the fee. Pay the small fee that it costs to chuck your money into these funds. If you're doing big long-term investing, if you're putting £10,000 into an investment, you shouldn't be thinking about, what's the market fluctuation going to be like today? You shouldn't be looking at financial news at all. You should just be chucking this money into these fund accounts and just forgetting about it. Let people who snort crack cocaine for a living deal with it for you. You don't have to be a crack cocaine sniffer. All you have to do is save, save, save. Save your money. And once you've got a good fat chunk of capital, you can start behaving like a rich kid. And by that, I don't mean, going out and being degenerate, buying a Lamborghini and all that crap. No, that's just degeneracy. By being a rich kid, what I mean is, flaunting 40k at the bank, just slapping it down on the table and being like, can you chuck that into a bond account for me? Can you chuck that into a safe, ready-made investment for me? And the bank will rub their hands together and go, yes, of course we will. Yes, we will sort all that for you. Just pay our small fee. And, if it's an investment of £40,000, to use that example, the fee might be 0.5% of that. But when you look at the returns you're going to make, even regardless of that 0.5% fee, it still doesn't really matter. You're going to make such huge returns from those capital gains, it does not matter. So to summarize this video, I would very much say short-term investing is a poor person mentality. If you are a poor person and you go down to Betfred every day and you're, betting on the horses or you're betting on the footy, that's really what's going on here with these short-term investors. They're no different from the saddos you see in these Betfred shops, just gambling all their money away because they're so poor and they're so desperate that they think, if I just put in enough effort, I'll be able to maximize the short-term market and I'll be the next GameStop hero. It'll go to the moon. It won't. You'll be a poor person. You'll lose all your money. And you'll be an idiot. You'll be like that guy at the bottom there in this photograph. You'll be a complete moron. Don't assume that you're better than other people. You're not better than other people. You are an average human being, probably with an average midwit IQ like I've got, and you're not going to outsmart the market. The market is everyone trying to outsmart each other. You're not smarter than other people. So just work with the market. Save, save, save. Make sure you've got a lot of savings saved up. If you don't know how to save, see my video on Should You Invest, where I had a portion in that about, being a degenerate. Just don't be a degenerate. If you're not a degenerate and you don't go on holidays, that's a big one. If you don't go on holidays, you'll save so much money. Just save all that money up. Save it up into a cash ISA if you're poor, and then once you cross over the 20,000, 30,000 threshold, then you can start thinking about investing, and you can invest like a rich person.